Here we are talking about the theories of exchange rate determination. It is also an important topic, okay, other than the term structures of interest rate. Remember for risk management, in the ACCA F9 exams, it share about 16% to 18% of total marks in the paper. So in other words, and for this topic, it's mainly happen in section A and section B. Okay, in other words, for this 60% to 80%, okay, it's not how to say that, it's not a easy score or easy mark that you obtain. But if you understand it well, then you can go for the options because you are given option A, B, C, and D. You can get the marks by the correct calculation or the correct concepts behind you, that you can answer it correctly. Okay, it's not a very difficult part, but a lot of students I see it, they find this is difficult. Maybe they don't understand well of the logic between interest rate, between the inflation rate, especially when we go through into the theories. Okay, let me explain to you. Theories of exchange determination. Okay, two forces. Okay, we have to remember what drives the exchange rate movement in the long run. Okay, I'm not saying in overnight. Maybe in overnight, that, for example, Brexit will cause the British pounds to drop by 10% just overnight. But we are talking about long term. In long term, then two major forces drive the exchange rate movement between two currencies. For example, US dollars and British pounds. It's the inflation rate, and also it's the interest rate. Okay, we have two forces or factors that drive the movement of exchange rate. It is the inflation rate and also the interest rate. And for inflation and exchange rates, okay, we have the purchasing power parity theory, which is the rate of exchange between countries' currencies depends on their relative domestic purchasing powers. And the point here is the basics of PPP is about the law of one price. In international traded commodities, okay, they must sell for the same price in every country. I'm not sure whether you hear these terms. Benchmark index, okay, it is also the benchmark, okay, which is a hamburger selling by a fast food chain, the benchmark. A magazine found out the benchmark price in different countries and show in the list, finding out which country is selling the cheapest benchmark, which country is selling the most expensive benchmark. And it shows that it should be, if it is law of one price, it should be the same. All right, but they are not the same. For example, in US and in UK, if they convert the current exchange rate with the benchmark, just an example, maybe for US it is $3 for a benchmark. Maybe in UK, it is 1.5, for example, pounds. But okay, it means the exchange rate between US dollar and GBP, the British pound, is 2, right? But the market rate right now may be only 1.4. Okay, so it's the benchmark index based on the hamburger, assuming they are all the same to measure the exchange rate. Okay, it's based on law of one price. It means the purchasing power. If inflation occurs in US, for example, $3, maybe going up to $4, okay, inflation, For the British, okay, maybe maintain the same because low inflation. Then the exchange rate will be different, right? So right now is maybe 4 divided by 1.5 from the Big Mac index. It's now turned to 2.67. Okay, the exchange rate. Okay, this example indicated that when a country has higher inflation, its currencies will be depreciated, right? Because based on the Big Mac, the price increased faster than the other country's Big Mac. Okay, then given the same exchange rate, law of one price, given they exchange the same commodity, same hamburger, so you have to pay more to exchange for the equivalent currency of your counterparty of the other country. Here, for example, here maybe US, the US economy has suffered from high inflation, then the currency will be depreciated. We will explain that a bit longer later to ensure that you understand purchasing power parity. Here is the formula. You can find it in your formula sheet. Okay, the people sometimes confused about this formula. Okay, here is S1. It's the expected spot rate in period 1. Okay, the expected spot rate in period 1. And here S0. S0 means the current spot rate. Okay, here with two inflation rate, country C inflation rate and country B inflation rate. So in 1 year later, the expected spot rate is coming from this. Okay, here is only the expected spot rate. It doesn't mean it will happen. Okay, expected. So it shows you the trend. 1 year later, what's the currency will be going up or going down against the other currency. So here we would like to explain to you some terms or terminology. Spot exchange rate. Spot exchange rate is the rate at which you exchange one currency for another now. Okay. It's to exchange the currency, one currency for another now. It's spot rate. And forward exchange rate, we will explain it later in the IRP, okay, interest rate parity. Forward exchange rate is different. It is the exchange rate available today that is guaranteed or promised for an exchange of currencies that takes place in the future. So remember, these two are different, okay? For the PPP, for purchasing power parity, it is talking about the spot rate now and 1 year spot rate here, maybe example, 1 year spot rate later. But forward rate is the rate now for currency to be exchanged in future, which is guaranteed. Okay. And here is an illustration showing the PPP. Okay. For US inflation is 10% per annum. UK inflation is 7% per annum. And current spot rate between dollar and pound is 2. So required is you estimate 1 year dollar to pound exchange rate based on the purchasing power parity. Okay. Remember the formula? S1 S0 times 1 plus HC divided by 1 plus HB, right? And here, C is US and B is UK, because given the dollar to pound is 2 divided by 1, okay? It means 1 pound exchange for $2. So here, the S0 is 2, and the US inflation is 10%. For UK, the inflation is 7%. Okay. So here you can just come up the exchange rate in S1. The expected spot rate in S1 is 2.056. Okay. It means the US dollar against pound is depreciate. It means its value is dropping against British pounds. Okay. So to apply the formula, you have to understand. For example, I say dollar pounds is 2. Okay, it means pound 1, but I haven't written down. I haven't written down. So it's 2 against 1, and then it means dollar is country C and pound is country B. All right. So move on to interest rate and forward rates. Okay, remember for purchasing power parity, we are talking about the expected future rate, the expected future spot rate, the expected future spot rate. But for interest rate parity, it is different. We are talking about the forward rate. As that forward rate is the rate agreed now, and you have to guarantee and promise to exchange the currency in the agreed rate now. Okay. So right now we are talking about the interest rate parity theory. It implies that the rates of return on financial assets will be equal between nations. The rate of return on financial assets will be equal between nations. Okay, here. And the interest rate parity theory maintains the differences in national interest for securities of similar risk and maturity should be reflected in the forward exchange rate discount or premium, at which one currency is bought or sold forward against other. Okay, what does it mean? It means because you have to balance the financial rates of return of the asset, given they have the similar risk profile, then the compensation of the differences between the rate of return is on the forward rate. Okay, so here is the formula. It's also shown in the formula sheet. Okay, it's different. Okay, again, just repeat. It's not S0 or S1. It's F0. It means the forward rate now, quoted now. You go to the bank. You ask for the forward rate, for example, 6 months of a particular currency. They will use this formula to quote you the price. So as known, current spot rate and interest rate in country C and interest rate in country B. Okay, we have some information here. Central to the IRP theory is the concept of interest arbitrage, namely short-term capital movements to optimize interest discrepancy in international money markets. So it is the arbitrage mechanics. And here is an illustration. We have Euro interest rate is 3% per annum, and UK interest rate is 7% per annum, given the exchange rate between Euro and Pound is 2. So you have to find 1 year forward rate. Remember, forward rate is interest rate parity, IRP. 1 year expected spot rate is PPP. Okay, different. For forward rate, we use the interest rate parity. F0 equal to S0 times 1 plus IC divided by 1 plus IB. Given Euro Pound is 2. Okay, So now euro, the interest rate is 3%. And the British interest rate right now is 7%. We know S naught is 2. So here, 2 times 1 plus 3% divided by 1 plus 7%. So F naught is 1.9252. So in other words, you agreed the forward rate is at 1.9252. It means it gets the euro appreciates